Welcome to the initial class of this new course where we'll talk about the economic and financial analysis of investment projects. My name is Raffaele Oriani and I'm an associate professor of corporate finance at Luis Guido Carli University of Rome, and I'm responsible for this course. The title of the first lesson is Introduction to the Financial Analysis of Investment Projects. The class is organized as follows. First of all, we'll have a brief introduction. Then we'll talk about resource allocation and investment decisions, where we'll explain how the financial analysis of investment project is used within the broader activity of resource allocation. Then we'll talk about financial costs and benefits of an investment project. After that, we look at the different types of investments that can be the object of financial valuation. After that, we'll analyze the elements of financial analysis, so the different activities that you have to perform for the financial valuation of a project. And finally, we'll have a look at the whole process of financial analysis that combines the previous elements. So at this point, we can start from a brief introduction about the financial analysis of investment projects. And first of all, we provide the definition of what we mean for financial analysis of investment projects. We define that as the process of evaluating investment proposals to make appropriate investment decisions. In other words, financial analysis is providing decision makers with quantitative tools that can help them to make more effective decisions. In greater detail, we can say that the objective of financial analysis are the following. First of all, providing a bottom line for investors and other stakeholders. In other words, financial analysis, by providing a synthesis of the value of a project, gives usable and useful information to investors and other stakeholders to understand the value created by the project. Second objective is assessing the economic value of investment projects. The financial analysis of a project, in fact, is providing decision makers with the monetary value of the project. And finally, helping managers in strategic decision making. Clearly, the financial analysis of investment project is not the only activity that a manager is to perform in order to make a final decision, but it's an important one that can help the manager to combine monetary indicators with qualitative information to make better decisions. There are different stakeholders that are concerned about the financial analysis of a project. First of all, shareholders, because shareholders are interested in understanding whether the project is creating or not value for the company and for themselves. Then we have creditors that are interested in the fact that the company or the organization is spending the money in the right investment projects. The managers that, as we were saying before, have to make the final decisions about the investment projects, and the employees to the extent that they are concerned about the execution of the project. In order to better understand the role and function of the financial analysis process, we have to now give a look to the resource allocation and investment decisions, because the financial analysis of investment projects takes place within a broader set of activities that is defined as resource allocation within organization. In fact, firms must allocate scarce resources to alternative projects, so firms can have the need to allocate a scarce budget of financial resources to more convenient projects. So in the end, they have to select those projects that are more convenient. And this creates a need for investment project selection under capital constraints. So not only the firms have to evaluate the specific projects, but then the projects have to be compared in order to choose the projects that are more convenient. And the activity of evaluating projects and comparing projects, in the end, selecting the project that will be funded, is typically defined in corporate finance as capital budgeting process. In order to have also a more general picture of how firms allocate scarce resources to different investment projects, one interesting tool that we can use is the Boston Consulting Group Portfolio Metrics. This is a very well-known tool for strategic analysis that has been developed by the consulting company that is Boston Consulting Group, and is one of the main tools that is used for portfolio analysis when a firm has to decide in which businesses and projects to invest. So to better understand how this matrix works, we have to look at the two dimensions that allows us to define the matrix. Here on the x-axis, you have the project business market share. On the y-axis here, you have the industry growth rate. So this matrix is evaluating a business on the basis of the two dimensions. One is what is the market share that the business or the project is in its given industry, and second is how is this industry growing. So if we consider these two dimensions, we can individuate 4 different types of business or projects depending on the levels of analysis. On the upper left corner here, we have the star businesses or projects that are the businesses that are characterized by both a high market share and higher industry growth rates. So clearly these are the most attractive businesses or projects for a firm because they are both businesses with high market share and businesses that are related to industry that grows faster than others. These businesses, however, are burning cash. They are burning cash because firms need to invest a lot of financial resources in order to keep the pace of the continuous growth. On the other part of the matrix here, so on the lower left corner, we have the businesses or projects that are defined as cash cows. So these are businesses where the firm has a high market share, but they are related to businesses, to industries that have lower growth rates. So these are typically mature industries. So these businesses generate a lot of cash because they have high revenues, but they don't need so much investment because the industry is not growing anymore. So these businesses generate cash that is used to fund the other businesses of the company. On the upper right corner, we have the businesses that are defined as question mark. This is because these businesses are in industry that grows faster than others, but where the firm has a low market share. So the firm is not really safe, it's not really secure about the future direction of these businesses, but as the industry is interesting, this means that these businesses have, however, to be funded. And finally, on the lower right corner, we have those businesses that are typically defined as dogs, because these businesses are not interesting at all, as they are in mature industries where industries are not growing, and where the firm has a low market share. So these businesses or projects should be cut as soon as possible. So the final objective of this matrix is to achieve a balanced portfolio of businesses in terms of cash generation. In other words, the firm should have businesses both in the cash cow, star, and question mark quadrants. This is because the cash cow businesses generate cash that then can be used to fund the businesses that are defined as stars or question marks that are the most important for future growth of the firm. So the Boston Consulting Group portfolio matrix is useful to drive the resource allocation decision of a firm and to complement the quantitative financial analysis that will be described in this course. So now we can look in more detail at the financial costs and benefits of an investment project. Looking at financial costs and benefits allows us to better understand the financial nature of a project and the indicators that will be considered in the financial analysis of a project. At the first view, we can individuate these types of financial costs and financial benefits of an investment project. So in this table on the left side, we have an indication of the main financial costs, whereas on the right side, we have an indication of the financial benefits that we expect from a project. So let's look before at the financial cost that a project is going to generate in the future. First of all, we have capital investments. So capital investment is the investment that the firm makes in order to buy the fixed assets that are needed for a project. So fixed assets will be analyzed in greater detail in next classes, but at the moment we can define them as those assets that have a long-term life and conventionally a life that is longer than 1 year. Then we have the working capital. The working capital is made by those assets that are used by the project but have a short-term life. So conventionally have a life shorter than 1 year. Both capital investment and working capital requires financial expenditures as they require the firm to buy these real assets, then will be used and consumed during the life of the project. But we are not to forget about another very important source of cost for a project, that is the opportunity cost of capital. So the opportunity cost of capital is the expected return that the investors require on this project. In fact, the investors are providing the firm or the organization with the financial resources that the organization needs for this project. But they don't do that for free. They expect that these financial resources will be remunerated. As we'll see in the next classes, there are two types of investors that typically provide money to the firm for the realization of a project. These are equity investors or shareholders and creditors. Equity and debt capital are different sources of financing that have different costs and different risks. But what we have to remember at the moment is that both shareholders and creditors are requiring a remuneration on this capital. So the remuneration that is asked by these investors is an important component of cost for the firm, because firm will have to sustain a cost in order to guarantee the needed remuneration to these investors. On the right side of this table, we have the financial benefits. So a firm is in general investing in a project because it's expecting cash flows from this project during its life. So we'll define cash flows in greater details in the next classes, but at the moment it's important to understand that the cash flows are basically the difference between the inflows and the outflows generated by a project, where the inflows are mainly related to the revenues generated by a project, whereas the outflows are mainly related to the costs that the firm sustain for this project. So in order to better understand the financial benefits and financial cost of an investment project, we can refer to this logical framework that is in these slides that allows us to better understand how the cost of capital compares to the project returns. So in this framework, we can see that on one side, we have the financial resources that are invested by the firm in this project. And on the other side, we have the real assets that are bought and consumed for the project. So in other words, when we start a project, we have a given amount of financial resources that is invested to buy real assets that will be used in the project. On the financial resources, the firm has to pay the cost of capital we were mentioning before. So in other words, the firm has to pay investors the returns they expected for providing the financial resources. So what is happening is said on the right side of this slide. So the real assets that are bought before and during the project are then used within the project, in the operations of the project, to generate financial cash flows, to generate the financial benefits for the firm. These financial benefits will be used for the returns, the effective returns that the project is generating for the investors. So on one side, on the left part of this slide, we have the returns that the investor expects at the beginning from this project. On the other side, we have the returns that the project is able to generate for the investors given the projections of the future financial benefits. So when can we say that a project is convenient? Well, we can say that a project is convenient when the project returns that we expect from project executions are higher than the expected returns of the investors. So in this case, when project returns are higher than investor expected returns, the project is convenient. The project returns will depend on the ability of the project to generate financial benefits. The investor expected returns instead, as we'll see later in this course, depend on the risk that is perceived by financial investors that provide financial resources for the execution of this project. So at this point, we can look at the different types of investments that can be the object of our financial analysis. We can have different types of investment that can be more simple or more complex depending on the nature of the investment. So the first two types of investment that we can consider are new capacity creation or expansion. These investments refer to a situation where a firm needs to expand its production capacity or to create a new capacity to sustain the production of existing goods or eventually of new products and services that the firm has generated. In this case, the investment is made by a new plant or industrial sites that a firm can use in order to increase the production of given products and services. Then we have another case that is the case of technological substitution. In some cases, the technology a firm is using for production can become obsolete for both economic and technical reasons. So a firm can have the need to substitute the existing technology. So this means buying a new plant or installing a new technology in its existing plants, or to buy new machinery, a more efficient machinery, for example, passing from mechanical to numerical control machines. And in this case, we have to understand whether substituting the existing plant with the new plant or substituting the existing machinery with the new machinery is convenient or not for the firm. Then we have more complex investment projects that are related to innovation and new product development. So what do we mean for innovation and new product development? We mean all those research investments that are aimed to generate new products and services. So these kind of investments are different from the previous investments where you were buying assets that allowed you to increase the production capacity or to change the existing production technology, but mainly for existing products. So these kinds of investments are more complex because they refer to new products and services, so they are characterized by much higher uncertainty about the technical success of the project, because you don't know whether these new products or services will be efficient or effective, and they will be characterized also by higher market uncertainty, because most probably these products will be sold in a market that at the moment does not exist yet. So the valuation and financial analysis of these projects is more complicated than the project that we mentioned before. Then we have the investment in internationalization. That basically means investment in new production or commercial facilities in new countries. A firm typically makes this kind of investment when it wants to enter new markets, new countries where it's not present at the moment. And these investments also entail a higher degree of uncertainty than the investment in new capacity, because when you enter a new market, a new foreign market, there's high uncertainty about how the new foreign market will accept your product. And moreover, typically you have a weaker knowledge of the foreign market than of the market where you already operate as a firm. And finally, we have the most complex investments that are the mergers and acquisitions. So for mergers and acquisitions, we mean the acquisition of other firms. So these are clearly the most complex investment, because they require the acquisition of a new entity and subsequently the integration of this new entity within the existing company, within the acquiring company. So as you can understand, merger acquisition can have a series of consequences for the activity of the firms that requires a complex assessment of all the financial consequences. So from a financial point of view, merger acquisition will require a much deeper analysis given their complexity. So as we have seen in this discussion of different types of investment, you can analyze from a financial point of view different types of investment, and the financial analysis will have to adapt to each of these investments in a flexible way, because each of these investments presents specific characteristics that have specific features that have to be analyzed from the financial point of view. So at this moment, we can look in greater detail at the elements of financial analysis. So financial analysis is a complex activity that requires several steps and several different sub-activities. But the first thing that you have to do when you perform the financial analysis of a project is estimate financial results, in particular projected pro forma financial statements. So in other words, the basic and necessary condition to perform the financial analysis of a project is the estimation of the financial results that the project will generate in the future, in the next year, during its life. In order to do that, you need the projection of the balance sheet and the income statement and cash flow statement of the project. So the balance sheet is document when you will project the assets and the financial sources of the project. The income statement is the document where you project the revenues and the cost of the project. And the cash flow statement is the document where you will project the outflow and inflow of the project. So the word pro forma in this context is indicated to characterize that these documents are not the historical one, but are the projected one. So these are documents that are based on forecast and not on historical data. So these financial documents and this projection will be the basis for the other activities that have to be performed within financial analysis. The second element of financial analysis is derivation of financial indicators from pro forma statements. So once that you have elaborated your pro forma balance sheet, income statement, and cash flow statement, from these numbers you can derive financial indicators that are then used for financial analysis. So in other words, the pro forma financial statements are the basis for financial analysis, and then the numbers that are in these documents are used to calculate specific indicators that are typically built as ratios or more complex mathematical indicators that then are used to provide the answers needed in the financial analysis. However, calculating financial indicators is not enough. And the reason why it's not enough is because different projects are characterized by different risks. And we assume, in general in finance, that investors are not indifferent to risk. In particular, the basic assumption that is made in financial analysis is the investor is risk averse. So what does it mean? This means that the investors, ceteris paribus, prefers less risky projects. So when you compare different projects, because you have to select one project or more than one project, but then you have to select among more than one project, it's important to take risk into consideration because you could have projects that have the same financial indicators but different degrees of risk. So in order to properly account for risk in financial analysis, we have to calculate risk-adjusted financial indicators. So the financial indicators we were mentioning in the previous slides have to be adjusted in order to account also for risk and in order to account for the risk aversion of projects. In other words, these financial indicators will be modified in order to account for the fact that given the financial performance of a project, you will prefer projects with a lower degree of risk. And finally, the final element of financial analysis is to make an appropriate investment decision. So in the end, the decision maker is to select a given investment, and all the information that is being generated by the financial analysis will be useful for that. We have to specify from the beginning, however, that financial analysis is not the only analysis that will be performed by the decision maker, and the decision maker typically combine different sets of information before making the final decision. So the quantitative indication that come out from the risk-adjusted performance indicators are one of the elements that the decision maker will consider in making the decision, but then there will be some other strategic or qualitative consideration that can affect, in the end, the decision that the manager or the decision maker is doing in the end. So once that we have understood the different elements that are part of the financial analysis project, we can focus on the process of financial analysis. That is the last topic of this class. The different elements, in fact, that we've seen before are typically organized within a clear process that is at the basis of the financial analysis of investment projects. So here we'll look in particular at the stages of the financial analysis process. So as I was saying before, we can identify some specific stages in the process of financial analysis of investment projects. The first stage, that is defined as background, requires to get the market and technology information. What does that mean? Before starting the financial analysis of a new project, you need to understand what are the future market conditions, and you need to understand what the technology is, and if it's a new or existing technology, and if it's a new technology, what are the chances of success of this technology. So it's typically this is information that is collected before starting the financial analysis of a project, and it's typically not collected by the financial expert, but is collected by the marketing and the production departments or by external consulting firms, and it's acquired by the financial expert as an input for the next steps of the financial analysis process. So the second step of the financial analysis process is the investment capital structure. So here we have two different elements. One is the investment structure, the other is capital structure. These elements will be the object of detailed discussion in next classes. But what we need here to understand is that we have to understand, first of all, the investment structure, that is, what is the total cost of the investment and for what? So what do we need to buy before and during the life of the project? What are the real assets that we need for project execution? Whereas the capital structure pertains to how you fund the project. So the investment is generating a given financing need, a given need of financial resources. So capital structure means basically which kind of financial resources you are using, what are the sources of financing, who is providing the financial resources you need for this project. So the third step is about the operations of the project. The operations means how the project is executed. So means how you foresee to produce goods and services, what technology you are using, what plants you are using, where you are producing, how much raw materials are you stocking in your warehouse, which markets you are selling, which distribution channels you are going to use. So operations refer to the execution of a project. So all the different elements of the execution of the project that clearly are important because operations are generating revenues and costs that are relevant for financial analysis. Then we'll have the financial statement. So as we were saying before, at this point you have all the information you need in order to have the projected balance sheet, income statements, and cash flow statements. In other words, at this point you have to combine all the information about the market, the technology, the investment, the financial structure, and the operations into financial documents that you can use then for financial analysis and for the calculation of the financial indicators we have discussed before. And that we'll discuss in details in the next classes. At this point it's time for financial appraisal. Financial appraisal means that we use information in the projected financial statements to build financial indicators, and on the basis of these financial indicators we are providing a monetary value for a project. Clearly, we expect that if the value of the project is positive, this is a project that is convenient for the firm and should be realized. On the contrary, if the value of the project turns out to be negative, this is a project that is not convenient, and the firm or the organization should reject this project. Clearly, the fact that the value is positive or negative will depend on a set of assumptions that we make, so it will be also interesting to understand under which conditions a project will leave a positive value. At this point, once that we have evaluated each project specifically and we have attached a monetary value to each project, and we have selected only these projects that have a positive value, we have to evaluate alternatives. So we have to have the evaluation of alternatives. Because the fact that a project has a positive value does not mean necessarily that the project is to be funded, because as we were saying before in this class, the firm could have limited resources, so could have constraints, and could realize only a part of the projects, even though all the projects are convenient. So after the financial appraisal of each project, the project has to be evaluated in a comparative fashion, and in this way the firm will be able to select only these projects that create most value for the firm. In the end, the last step of the financial analysis process is the approval-disapproval stage. Clearly, at this point, the manager or the decision maker will have to make the final decision about the project. It's important to recognize since the start that financial analysis is only one of the elements that typically managers and decision makers take into consideration, because there could be other qualitative or strategic information that are relevant to the decision, and in some cases could prevail on the financial analysis process. But the financial analysis process is anyway a very important process and a very important help for decision making in deciding whether to approve or disapprove a project. So this class is ended, and remember that you can find the additional materials on the course website.